The imposition of sanctions by the Trump administration on Russia's two largest oil companies, Rosneft and Lukoil, represents a significant escalation of economic pressure aimed at compelling an end to the ongoing conflict in Ukraine. These measures, announced by the U.S. Treasury, target the core revenue streams funding the Russian war machine, marking a major policy pivot for the administration. The effectiveness and broader impact of these sanctions, particularly on global energy markets and key trading partners like India and China, are now under intense scrutiny. Summary and analysis. The sanctions, which include freezing U.S. assets of Rosneft and Lukoil and barring American companies and individuals from transacting with them, are designed to restrict Moscow's access to international finance and technology. Rosneft, majority state-owned, and Lukoil, a major private entity, collectively account for a substantial portion of Russia's crude oil exports. Critically, the U.S. is also threatening secondary sanctions on foreign financial institutions dealing with the two firms, a powerful tool intended to enforce compliance across non-U.S. jurisdictions, specifically targeting major buyers like India, China, and Turkey. This move signals a growing frustration within the Trump administration over the lack of progress in peace negotiations with Russian President Vladimir Putin. Having previously favored tariffs and a less confrontational approach, this action demonstrates a shift towards more direct economic warfare. The sanctions packages are among the largest imposed by the U.S. against Moscow, underscoring the determination to sever the financial lifeline that oil and gas revenues provide to the Russian budget. Reasons and consequences. Reasons for the sanctions. The primary motivation is unequivocally to choke the funding of the Russian war effort in Ukraine. Taxes from the energy sector are a critical source of revenue, accounting for roughly a quarter of Russia's budget. By targeting the largest oil producers, the U.S. seeks to reduce Russia's foreign currency earnings and curtail its ability to finance military operations. Furthermore, the sanctions are a clear signal of U.S. commitment to pressuring Russia into meaningful negotiations for a ceasefire, following the collapse of a planned summit between President Trump and President Putin. They represent an attempt to coordinate with allies, as both the UK and the EU have also announced or proposed parallel sanctions, including an EU ban on Russian liquefied natural gas (LNG) imports. Immediate consequences. The immediate consequences were visible in the global markets. Oil prices surged, with Brent crude rising by over 5%, reflecting market fears of a significant disruption to global crude supply. This price jump immediately boosted shares in major Western energy companies like Shell and BP. Geopolitically, the sanctions have put major oil importers, particularly India, in a difficult position. Having emerged as the largest buyer of discounted Russian seaborne oil since the start of the war, Indian refiners are reportedly reviewing their contracts and preparing to drastically reduce or halt imports from the sanctioned entities to avoid potential secondary sanctions from the U.S. Similar reactions are reported from Chinese state oil majors. This has immediate disruptive implications for global energy trade flows. Long-term consequences. In the long term, the sanctions' impact will hinge on the degree of U.S. enforcement of secondary sanctions. For Russia, the measures will increase transaction costs, potentially force Russia to sell its oil at wider discounts, and restrict its ability to invest in new technology and international projects. While Russia claims strong immunity, the loss of major buyers in Asia and the constriction of its shadow fleet capacity, especially if foreign banks are deterred, will erode its revenue base, putting its domestic economy under greater strain. For global markets, the rerouting of a substantial portion of Russian crude, nearly half of its exports, will create supply anxieties, potentially leading to higher and more volatile oil prices globally. This could exacerbate inflationary pressures in consumer nations, posing a challenge to the U.S. administration's goal of maintaining low domestic energy costs. For non-allies, India, China, they face an intensified diplomatic and economic balancing act. They must weigh the economic benefits of discounted Russian oil against the risk of losing access to the U.S. financial system and market. This pressure could accelerate a longer-term shift towards non-dollar trade for oil, a key Russian strategy to circumvent sanctions, but this development remains slow and complex. Prediction and solutions. Prediction. The short-term prediction is for increased market volatility and a temporary drop in Russian oil exports as buyers comply with the new measures. Key Asian buyers like India will likely experience a significant and abrupt reduction in Russian crude imports. However, in the medium to long term, Russia will likely attempt to develop workarounds. This may involve increasing sales through non-sanctioned intermediaries, expanding its own shadow fleet, or redistributing domestic oil supplies to maximize non-sanctioned exports. The sanctions' lasting success will depend heavily on the sustained and robust enforcement of secondary sanctions against facilitating banks and buyers. If enforcement is aggressive, Russian oil revenue will be significantly curtailed. If enforcement is lax, the market will find ways to adapt, mitigating the intended effect. Given the unprecedented nature of targeting the two largest producers, a material long-term impact on Russia's revenue is likely, but the process will be slow and may be accompanied by sustained global energy price hikes. Solutions and mitigation. For the U.S. and its allies, the most critical solution is a unified and aggressive enforcement mechanism for secondary sanctions. This must target the financial institutions enabling the trade, not just the tankers. To mitigate the energy price risk, the U.S. could 1. Coordinate with OPEC Plus to encourage a moderate increase in non-Russian oil production to offset supply fears. 2. Release strategic petroleum reserves to calm market spikes, though this is a temporary fix. 3. Provide clarity and safe harbors for certain essential energy transactions to prevent a complete market panic while maintaining pressure on Moscow. For nations like India, the solution lies in rapidly diversifying their crude oil sourcing away from Russian entities to avoid sanctions risk. This means re-engaging more heavily with Middle Eastern, African, and North American suppliers, potentially at a higher cost. Ultimately, a geopolitical solution that leads to a genuine ceasefire in Ukraine remains the most effective way to eliminate the need for these disruptive energy sanctions.